Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. Prices have overall, for the most part, continued to move up and away from the previously highlighted congestion zone below, made up from the lesser Fibonacci lines at 1400, 1389 and 1378. I saw the original move down to this area of lesser Fibonacci lines as an ammunition gathering exercise for the move up higher. Plus we have the results of a larger process also in operation. And that is the July to late October 2022 descending triangle, which I've highlighted in dark blue on my daily chart. The upper trend line used what was the now defunct mid-August 2022 downtrend. Meanwhile below, those same levels of 1400, 1389 and 1378 acted as the base of this triangle. At the end of November and going into December last year, prices punched up and over the 50% Fibonacci line of December 2020 to February 22 move at 1451 and started on the upside properly. The potentials on the upside from the descending triangle pattern, as I said 12 weeks ago, were, and I quote, "So, taking all that into account, a primary target X would be in the 1545 area and a secondary and much harder to reach target X1 would be in the 1605 area." End of quote. I also added something at the time which has turned out to be very prescient, and I quote, "So what have we topside that might get in the way?" Well, to be honest, not much, which is why I'm a little surprised and concerned that prices have not moved higher than they have. You see, we have highs in September at 1493 and 1508. The next clear resistance topside is in a band between 1521 to 1534, containing a flat long moving average. Flatlining long moving average. Now, the long moving average now is actually dipping lower and is currently 1488. I continued, and the 50% Fibonacci line for 2022 at 1532. End of quote. Well, since those words, prices have eased higher, breaking over a number of capping factors, including the long moving average. In the process, the market created and started utilizing a new pattern, a bull channel from mid-November 2022, currently at 1526 to 1572, which is highlighted in purple on my daily chart. In a move higher, prices 3 weeks ago and again last week breached but did not break the next resistance, and that's the 50% Fibonacci line of the February to July 2022 move at 1532. The market also had tested the upper bull channel line 3 weeks ago, as well as reaching a high on Tuesday last week of 1544 3/4, or only a quarter under the optimal target X of 1545. Now, I could say that the market reached that area, but I'm reserving my thoughts on that for the moment. However, I did say 2 weeks ago, and I quote, "Now normally after grazing a target that way, I'd pay special attention to the pattern and knocked it lower. But at this time I'm cautious about yesterday's action being a turn lower. You see, the action still looks somewhat lacking in strength, though I would still give the action over the next few days some close attention. I'm just mindful that the bull channel just looks a lot stronger than this one-day pattern, at least for now. That being said, target X1, the secondary target topside, is still a long, long way away." End of quote. Well, since that time, prices headed lower and punched down through the lower bull channel line. And I thought back then, I better start sharpening my crayon to give potential targets on the downside. But, and it is an important but, the market then created two 3-day bullish patterns. Firstly, a bullish morning star pattern over the first 3 days 2 weeks ago, and secondly, a horn bottom over those same days, resulting in prices last week moving up and over and around the lower bull channel line, but from below. It looked like we might be seeing a recovery and possible repair of the bullish incentive and the original bull channel. 2 weeks ago, I gave two possible options for such a way ahead, and I quote, "Firstly, we go back to where we were, within the purple bull channel again. This is possible, though the false breaks either side leave a lot of questions. Secondly, perhaps, just perhaps, the market is now moving over to a shallower bull channel type action originating from late December, and the one I've highlighted in bright red, That's currently 1484 to 1554. I suppose the third option would be a straight move lower, but I have a suspicion that may not be the way, at least right now. End of quote. Well, the market has seemingly lent towards the second option, but it has as yet not completely let go of the original purple bull channel. That ought to be happening in the coming days and week, but we shall see first to confirm. Chicago soybean meal. We have had here, and have here still for months now, different patterns, not so much melding in with each other, but rather crashing in and out of each other. The main pattern continues to be the May to date, May 22 to date, seemingly broken, then repaired, ascending, expanding wedge pattern. A pattern that I had pointed out many months ago. This had developed, but is looking pretty ill now. It was never a perfect pattern by any means, but it seemed to work until the end of last year. To assist in seeing this pattern, I've highlighted it in dark blue. It's worth noting that the lower trend line is also the neckline of the huge December 2021 to June 2022 head and shoulders continuation pattern. Upon much reflection, I am thinking about downgrading it for next time, as there's enough going on nearby that deserves some closer attention. Next patterns to look at are the ones that caused the peak of the market in early and late December last year, as well as last and this week. It was a combination of the 2021 high at 1471.40, inflamed, yes, I think that is a good way to describe it, inflamed by the neckline, which I've highlighted in bright red, of the February to April 2022 head and shoulders top, currently at 476.20. I should perhaps clarify that the June 2014 high at 479.30 has also helped, eventually capping the rises. In between the two most recent peaks, the market staggered lower, which includes a changeover gap action 3 weeks ago. The market dropped down to just short of the April 2021 high at 439.30, where it has seemingly found some ammunition to turn back up in mid to late January. Now, I suspect this might be due to the rising short-medium moving average below, currently at 454.40. This has left us, as I have said over the last few weeks, with a question of what may be the likely patterns in the coming weeks ahead. Initially, I indicated there was a tendency to look at the late November 2022 to January this year action as a possible bullish halfway hesitation. That idea has been somewhat set aside, but it is still out there. The changeover gap in mid-January has added the concept for the same action, instead of being a bullish halfway hesitation, of being a possible lopsided double top. Neither idea is ideal, indeed they are both far from ideal, but that is all that is showing right now. Needless to say, it is too early to even contemplate targets for either of these potential ideas right now. Chicago soybean oil. The key recent features here have been feature 1, the lower time, currently at 61.34 of the December 2021 to June 22 bullish shift picture, which I've highlighted in dark blue on my daily chart. This lower time, along with feature 2, the April 2020 today uptrend, currently at 61.90, which I've highlighted in bright red, both halted the decline in mid-December last year, starting a small subsequent move higher, or rather, they may have started it, but it was not accomplished just with those two. No. They had help from a whole series of other supportive features, including but not exclusive to the 2011 high at 61 even, and supports at 59.44, 58.82 to 58.16, inside of which is the August 2011 high at 58.59, plus the September 2012 high at 57.64. This all caused the market to revert back up and in the process form an interesting small ascending wedge pattern over December last year. I've highlighted this pattern in bright green on the daily chart. In late December, the market broke down through the base of this pattern, thus initiating a primary target in the 64.08 zone and a secondary much harder to reach target X1 in the 58.82 zone. The primary target was easily achieved, but the harder to reach secondary target was harder to reach, and as in front of it there were the lower time and the uptrend as barriers. It finally took until this past Monday for the market to dip down to reach target X1, only to immediately revert back up, which in its own way is satisfying, but then again not necessarily constructive. However, I should point out that last Friday through to this past Tuesday did form a possible 3-day bullish morning doji star pattern. The only issue is that there has been no follow-through high. In fact, it looks like the market may be trying to drop down again into the congestion between 58.82 to 58.16, which has the August 2011 high in there at 58.59, and maybe even as low as the September 2012 high at 57.64.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.